So it's a fact of life that nothing gets built, not a bridge or a pipeline or a building, without two things: financing and insurance. So both banking and insurance touch every sector, every country in the world. And while banks have made a lot of progress on integrating ESG into their risk management processes, insurance in general is somewhat behind. But the insurance industry inherently has a long-term view, and they also have ESG risk exposure from all types of business activities that they underwrite. So ESG is really a natural fit. And while a lot of progress has been made on ESG in the asset management arms of firms, there's still a long way to go when it comes to holistically integrating ESG in the underwriting processes. So underwriting in insurance involves assessing the factors that determine a potential client's risk profile before deciding whether that company should do business with them and at what price. And ESG compliant underwriting will take into account parameters that are largely not considered at the moment, such as human rights or labor rights. But if ESG is taken into consideration in the risk management processes, insurers will be able to better price risks, better manage reputational risks across their client base, and simply just have a more future-proof risk management process. So insurance companies primarily use RepRisk for two key things: to embed ESG into their underwriting processes and to integrate ESG on the investment side. And in underwriting, clients use RepRisk to conduct ESG due diligence as part of the underwriting process. Then post-transaction, they will use RepRisk for ongoing monitoring or periodic client reviews or business reviews for emerging ESG and reputational risks. They can also use RepRisk to assess and map risks at the country and at the sector level, and also use RepRisk to ensure compliance with various international standards, such as the UN Principles for Sustainable Insurance, the OECD guidelines for multinationals, SASB, the SDGs, and so on. Then on the investment side, insurers will use RepRisk basically the same way that any other investment management client would use RepRisk. Our particular strength is to serve as a risk overlay as part of ESG integration. And because we're the only provider to systematically cover private companies and also companies in emerging and frontier markets, we can uniquely support ESG integration across all asset classes. So let's look at a practical example of how an insurance firm would use RepRisk. Generali's been our client since 2017. They are the leading insurer in Italy and one of the largest globally. And they consider themselves to be a responsible insurer. And as part of that work, they integrate ESG data from RepRisk into their areas of underwriting, asset management, and also into their corporate social responsibility activities. And their risk management process requires them to ensure that all material and emerging risks are properly identified, measured, and reported. And this is the case even more so for sensitive business transactions and sensitive business sectors. So essentially what RepRisk does is to help them to achieve an efficient screening of ESG risks on both sides of their balance sheet. So underwriting is first and foremost about risk. And risk is really in our DNA because our background comes from credit risk management. And we evaluate the ESG risks linked to companies and to infrastructure projects through this outside-in perspective. And what I mean by that is that we're looking at public sources, public stakeholders, external to the company, rather than looking at company reporting and disclosures. Essentially, we help our clients assess whether companies walk their talk when it comes to ESG. And we do this work through a unique combination of AI and machine learning together with human intelligence. And the way that we see it is we take the best of both worlds. So technology really helps to drive size and scale and speed. And then the human analysts are important for making sure the data has depth and relevance to our clients. So we launched this data set 15 years ago. So we have a long track record of experience, and we've been updating the data every day from day one. And finally, very important these days is that the methodology behind providing this data set is rules-based and it's fully transparent. So it's available on our website for all to read. This approach has helped us to build the world's largest data set on ESG risks. So today we're covering over 180,000 public and private companies from every sector and every country in the world, including emerging and frontier markets, as well as over 50,000 infrastructure projects, so bridges and tunnels and pipelines and mines. So in the end, RepRisk, what we really do is provide data that provides our clients a more holistic view of ESG risk exposure to enable more informed decision-making. Well, I think it's safe to say that generally ESG has reached the mainstream in the last 18 months. And traditionally, insurers have led the way in terms of tackling climate change. And there's a lot of momentum building around the formation of the Net Zero Insurance Alliance. However, it's important to keep in mind that the E in the ESG does not exist in a vacuum. There are social implications linked to climate change, such as community displacement or inequality. And beyond that, there's other social issues, such as human rights or labor rights, that also should be considered in underwriting due diligence. Another thing we're seeing is that we see more insurance companies aligning themselves with the UN Principles for Sustainable Insurance, as well as the UN Sustainable Development Goals. And both of these are very encouraging trends.